February 1637. A candlelit tavern in Haarlem, in the Dutch Republic. An auctioneer holds up something small, brown, and ugly. A flower bulb. The month before, bulbs like it traded for more than the price of a fine Amsterdam canal house. Tonight, the auctioneer calls out. Silence. He lowers the price. Silence. Within days, the most spectacular boom of the age is over. For centuries of technology later, we've upgraded everything about markets except the thing that actually drives them. The human brain. This is the story of fear and greed. Rewind a few years. Tulips arrived in the Dutch Republic from Ottoman gardens in the late 1500s, and the rarest ones, streaked with flames of color, became status symbols for wealthy merchants. By the mid-1630s, trading had moved from gardens to taverns, where buyers and sellers swapped paper claims on bulbs still buried in the ground. The Dutch called it windhandel. The wind trade. Trading air. Prices detached from the earth. Contemporary pamphlets claimed a single Semper Augustus bulb was quoted around 10,000 guilders, when a skilled craftsman earned roughly 300 guilders a year. By the winter of 1636, the frenzy had spread down the social ladder to weavers and innkeepers. One often quoted pamphlet priced a single rare bulb against a whole basket of real wealth: wheat, rye, oxen, pigs, wine, beer, a bed, and a silver cup. People weren't buying a flower. They were buying the certainty that someone else would pay more. Then, at a Haarlem auction in early February 1637, the bids simply didn't come. Confidence, the only thing holding prices up, evaporated in days. Now, modern historians have shown the legend outgrew the facts, and relatively few fortunes were truly ruined. But as a portrait of crowd psychology, the tulip winter is perfect. Because every ingredient in that tavern is still inside your head. Start with the deepest wire, loss aversion. In 1979, psychologists Daniel Kahneman and Amos Tversky showed that losses hurt roughly twice as much as equivalent gains feel good. Losing $100 stings about twice as hard as winning 100 delights. That asymmetry warps behavior in both directions of a cycle. On the way up, people hold winners nervously and take profits too early. On the way down, they refuse to realize losses, holding and hoping, until the pain maxes out and they sell everything, usually near the bottom. Researchers call that second half the disposition effect, and it shows up in millions of real trading records. People are measurably quicker to sell positions showing gains than positions showing losses. Panic isn't stupidity. It's an ancient alarm system doing exactly what it evolved to do, in an environment it never evolved for. The second force is hurting. Humans are wired to treat the crowd as information. If everyone's buying, they must know something. Economists call it an information cascade, and it's often individually rational. The result is collectively explosive. Even genius doesn't grant immunity. In 1720, Isaac Newton bought shares in London's South Sea Company, sold early with a tidy profit, then watched his friends keep getting richer. He bought back in near the top, and lost about £20,000, a fortune at the time. He reportedly said he could calculate the motions of heavenly bodies, but not the madness of people. John Maynard Keynes explained the mechanism in 1936 with his beauty contest. Professional investing, he said, is often not about picking the best company. It's about guessing what everyone else will find attractive. When a market runs on second-guessing the crowd becomes the fundamentals. Until it isn't. Force number 3, recency bias. Our brains quietly assume the recent past is the permanent future. Stretch a few good years into forever, and you get a mania. Stretch a crash into forever, and you get a generation that never trusts markets again. Economists have measured this directly. Ask people in surveys to forecast market returns, and the answers largely track whatever the market just did. Reported optimism has historically peaked right after the biggest gains, exactly where the future turned out least generous. The cleanest case study is the dot-com bubble. Through the late 1990s, U.S. stocks delivered years of spectacular returns, and investors extrapolated. The Nasdaq index rose from about 1,000 in 1995 to 5,048 on March 10, 2000. Companies with no profits doubled on their debut. Some firms saw their share price jump just for adding .com to their name. Then the mirror flipped. By October 2002, the Nasdaq had fallen about 78%. And in March 2009, at the bottom of the financial crisis, the same bias ran in reverse. After a 57% collapse, investors extrapolated ruin, right as the market turned. The rearview mirror always feels like a windshield. It never is. Here's where it gets practical. Emotion sounds unmeasurable. It isn't. Markets produce a fever chart of their own feelings, and you can read it. The most famous gauge is the VIX, which uses option prices to measure how much turbulence traders expect over the next month. Its long-run average sits near 20. In November 2008, it closed above 80. In March 2020, it closed at a record 82.7. And in the eerie calm of late 2017, it closed near 9. Extremes on that dial have marked moments of maximum fear and maximum complacency. Options traders leave another fingerprint, the put-call ratio, which jumps when investors rush to buy crash insurance. And then there are surveys, where people simply confess their feelings. The American Association of Individual Investors has polled its members weekly since 1987. In January 2000, weeks before the dot-com peak, roughly 75% said they were bullish, a record. On March 5, 2009, for days before the bottom, about 70% said they were bearish. Even ordinary households leave a trace. The University of Michigan has asked consumers how they feel about the economy for decades. In June 2022, with inflation raging, that index printed the lowest reading in its entire history, gloomier than 2008, gloomier than 1980. Within months, inflation was falling. Read those numbers again. The crowd was most euphoric at the top, and most terrified at the bottom. Sentiment gauges are thermometers, not timers. But at the extremes, they've historically told you more about the crowd than about the assets. So why do cycles never stop? Because every generation gets new technology, new assets, and a new story, but the same brain. Canal shares in the 1790s, British railway stocks in the 1840s, radio stocks in the 1920s, dot-coms in the 1990s. The costumes change. The play doesn't. The economist Hyman Minsky described the deep loop underneath it all: stability breeds instability. A long calm convinces people that risk has been abolished, so they borrow more, stretch further, and quietly build the fragility that ends the calm. Greed isn't an interruption of the cycle. It's a phase of it. So is fear. Loss aversion guarantees panics overshoot. Hurting guarantees booms overshoot. Recency bias guarantees we mistake both for permanence. You can't patch these out of human nature, and honestly, you wouldn't want to. They kept your ancestors alive. But you can know they're running, in the market, and in you. That knowledge is the entire difference between watching a cycle and being swept away by one. Recap. Harlem, 1637, prices held up by confidence alone collapse in days. The machinery behind it, loss aversion, losses hurting twice as much as gains, hurting, the crowd as false information, and recency bias, the rearview mirror mistaken for a windshield. And the mood is measurable, through the VIX, the put-call ratio, and sentiment surveys that hit record greed in January 2000 and record fear in March 2009. Every indicator we've covered in this series ultimately runs on this fuel. So if you want to understand the next cycle before it arrives, and recognize the tavern in Harlem when you're standing in it, subscribe. The next cycle is already being written, by the same brain as always. This is educational content only, not financial advice. Always consult a licensed professional before making financial decisions.